Go ahead. So, hi, friends, everyone, and good evening, and welcome to another. I would say the last session, correct, Joe, on this series of doing business in United States. So, today we'll be focusing more on the case studies and the practical aspects of doing business in US, and also would touch upon specific matters of residential status and what it makes or what it takes for a person from outside US to come to US. What are the various permits required, be it for employment, self or normal employment. So yes, Joe. Over to you to take it from here.
Great. Thanks so much, Jugal. Good evening, good morning, or good afternoon, wherever you may be. I'm Joe Hillstead. I'm a partner at Squire. Very glad to be here. Very glad to have been invited by Jugal and DVS and their team. I'm joined by Sierra Hoggett on my team, and we're here to wrap up our series, our three-part series of doing business here in the United States. And we woke up this morning to snow in our part of the world, and it's 6:30 our time here near Salt Lake City, and so we had to shovel our driveways. I'm in the office, and I believe Sierra is working from home. So great. Well, let's get right into it. Jugal's got the slides up, and Jugal, can I take control?
Yes, please.
Okay. There we go. All right. Well, here's the agenda that we've got today. Just wanted to recap webinar 1. Then we'll recap webinar 2 briefly. Sierra is going to get into the visa types here, potentially of working and doing business here in the United States. I'm going to talk. Jugal asked us to do a little bit of a deeper dive into what the treaty calls dependent personal services. Dependent meaning having an employment relationship. An employee is coming to the United States. The second part of that is we're going to talk about independent personal services. So an independent contractor who comes to the United States, we're going to talk about those items. Lastly, we're going to talk about the base erosion tax, which is a relatively new tax, which would apply especially if a foreign parent, like an Indian parent, sets up a U.S. subsidiary and charges management fees or royalties or other intercompany transactions, how that may affect some corporate income tax for the U.S. subsidiary. And then lastly, we're going to get into a deeper dive into U.S. sales tax. So let's just recap what we did in webinar 1. Give an overview of the United States. Approximately 330 million people live in the United States. We talked about some of the largest states to do business in. California has, by itself is the 9th largest economy in the world. We talked about other populous states like New York, with the city of New York, which is the biggest city in the United States, followed by Los Angeles in California. Chicago is the 3rd largest city, and then Houston in Texas is number 4. We talked about financial statement audit requirements, right? Generally, there's no financial statement audit requirement unless you've got bank covenants or unless you are publicly traded, listed on a stock exchange like the New York Stock Exchange or the NASDAQ. We talked about choices of entities here in doing business, right? State law corporations, LLCs. We talked about the income tax regime for U.S. entities. We talked about what triggers a U.S. trade or business, or commonly called effectively connected income here in the United States. So, when are you doing business here? When would you be subject to tax? In webinar number 2, we touched on payroll taxes that are applicable when there's an employee here in the United States. Then we spent a lot of time on the transfer pricing rules here in the United States. And then lastly, we talked about recent legislation around the coronavirus and the impact that the coronavirus is having here, and some of the legislation that happened as a result of that. The biggest one was the CARES Act. There was another piece of legislation that was passed in December, abbreviated CAA, and there's lots of tax rules, lots of tax incentives, lots of stimulus payments, and forgivable loans to businesses here in the United States. They're kind of the second part of this CARES Act, commonly called the CAA. We're not going to get into that, but here in the United States, the virus is still raging, right? We're very optimistic. Many people here in the United States are receiving the first part of the vaccine. Many have received the second part, either under the Pfizer or the Moderna vaccine. That Johnson & Johnson just came out with a vaccine on top of that. So we're hopeful that we can return back to normal, doing business as normal, traveling, visiting clients, things like that. We hope that happens by the fall, but who knows? Under the Biden administration, the new president, there's a renewed effort to get the vaccine out to especially folks over 70 years old. So we are optimistic there.
The entire world is optimistic. Let's hope for the best.
Yep. Say that one more time, Jugal.
No, I said the entire world is optimistic, so hope for the best.
Yeah, really. We really do. I travel frequently to visit clients, Jugal, as I'm sure you do. It's I miss meeting in person with clients, as I'm sure all the rest of you do too. And I'm sick of Zoom and Teams meetings, and would love to be able to shake clients' hands and go to dinner and things like that.
Yeah, hopefully in the near future.
Yeah, exactly.
Yeah.
Exactly. Okay, well, with that, let's turn it over to Sierra to talk about the types of visas here in the U.S. that many non-residents can seek, and I'll turn it over to you.
Thanks, Joe. So first, I just want to start by saying that Joe and I are not attorneys or immigration officers. We're tax accountants. So this is not where our expertise necessarily is, but we did want to give a brief overview of a couple different types of the visas that are available. So all travelers that are entering the U.S. from other countries need a passport upon arrival, regardless of their country of citizenship. And then permanent residents and foreign nationals may also need a U.S. visa. And the U.S. Department of State issues visas to foreign nationals who are traveling to the U.S. So the reason for your travel to the U.S. will determine the type of visa that you need to enter. Some of the most common types of visas are immigrant visas for permanent residency, visitor visas for tourism or business. There's such thing as a fiance visa to marry your U.S. citizen fiance and live in the U.S. There's also visas for students and transit visas for traveling through the U.S. on your way to visit other countries. So today we're mainly going to focus on some of the visas for temporary and permanent workers. And first we'll start with the temporary worker visas. So L1A visas are for intra-company transferees who work in managerial or executive positions in a company located outside of the U.S. And L1B visas are for intercompany transferees who work in positions that require special knowledge. So the main two differences between these two visas are that the second one requires a specialized knowledge. Some requirements for having an L1B visa and an L1A visa are that they must have a qualifying relationship with a parent company, a branch, a subsidiary, or affiliate, anybody who's a foreign company. They must be doing business as an employer in the US, as well as in at least one other country, directly or through a qualified organization. And then they also must be seeking to enter the US to provide service in an executive or managerial capacity for whatever branch of the same employer or one of its qualifying organizations. An H-1B visa is for specialty occupations. So these are occupations that may require applying highly specialized knowledge. People who have these visas must attain a bachelor's or higher degree in the specific industry that they'll be working in, and also they need to hold a foreign degree that is equivalent or higher than the US bachelor's degree.
Yeah, and to add to that, Sierra, here in the United States, a bachelor's degree is generally 4 years of university, at an accredited college. And so that foreign degree equivalent to a bachelor's would be equivalent to that, 4 years of university or higher.
Exactly. Thanks, Joe. So E1 visas are next. These are for nationals of the treaty country that are engaged in international trade on their own behalf. For someone to qualify for this visa, they must be a national of a country that the U.S. maintains a treaty with. They need to carry on substantial trade, and they have to carry on principal trade between the U.S. and that treaty country. E2 visas are next. These are for those who are investors in U.S. businesses. So to qualify for this visa, someone must be a national of a country where the U.S. maintains a treaty again, and then he or she must also have invested a substantial amount of capital in a U.S. enterprise and must be seeking to enter the U.S. for the purpose of developing and directing the investment enterprise.
Yeah, and on this one, Sierra and I see this one frequently. We see these E2 investor visas. And in these situations, the U.S. immigration folks, like to know how much that investor is going to invest in a U.S. business. And we generally see it through capital contributions that are made by that U.S. investor. Many times that U.S. investor will come, they will invest, a certain amount of capital in their U.S. business, and they're here to get a startup technology company off the ground, and we see it frequently in Silicon Valley in the Bay Area, or Silicon Beach in Southern California, or even here in Silicon Slopes in the Mountain West of the United States in the mountains. But this is a very common visa that we see frequently.
So those were all temporary worker visas. Now we're going to talk about one permanent worker visa. This is the EB-5 visa, which is for foreign investors stimulating the U.S. economy through job creation and capital investment. So this type of visa is used to be reserved for investors who the amounts used to be those who are investing $500,000 in targeted employment areas or $1 million in other areas of the U.S. economy. However, as of November 21st, 2019, prospective EB-5 applicants now have to invest $900,000 if the investment is made in the targeted area. or $1.8 million in a new commercial enterprise employing at least 10 full-time U.S. workers. And then each year, there's around 10,000 of these EB-5 visas that are issued to applicants in all over different parts of the world. And this is one type of permanent worker visa, but there's also things like an EB-1 visa, and this would be for people with extraordinary ability in like sciences, arts, things like that. And it also includes multinational executives and managers. Okay, so moving on to the green cards. Green cards are essentially permanent resident cards that allow you to live and work permanently in the United States. The steps of obtaining a green card vary depending on everybody's. So there's many different eligible categories that may include qualifying through family, employment, as a special immigrant, and many other different categories. So coming from outside of the US, you have to make sure that you're eligible to apply for one of these, and then apply at a US Department of State consulate that's abroad for an immigrant visa in order to come here and be admitted as a permanent resident.
Yeah, and you know, the green card is one of the tests for U.S. taxation. Meaning, if an individual obtains a green card, like Sierra said, they are a permanent resident of the United States, and they will be subject to U.S. income tax at that point, right? So we generally ask folks that come here, do you have a green card? Yes or no? You know, if the answer is no, then we look to the treaty, and we're going to get into that. You know, if they are from a country where there's a treaty, an income tax treaty with the United States there, but that's kind of the second question. But so those that have a green card are treated as U.S. permanent residents. Many of them are seeking U.S. citizenship, but you know, as green card holders and as permanent residents, they would be subject to U.S. income taxation. Great. Well, thank you, Sierra. Anything else on visas?
I think
that's it on visas. Just a brief overview.
Yep. Jugal, you had a comment?
Yeah, I was just saying. I mean, the content was good to know about visas. You can proceed, Joe. Not an issue.
You bet. All right, so you know, Jugal asked us to go into some depth, and you know, give examples and kind of case studies of, you know, what it's like for, you know, what we call dependent personal services. So, you know, the first slide we've got here is for, you know, an Indian national, an Indian citizen who comes here to the United States, let's say as an employee of an Indian parent, to explore doing business in the United States. And you know, so what the first thing we ask is we look to the U.S.-India treaty. And the treaty says that any compensation that individual derives, you know, by an Indian resident in respect to the employment that's exercised in the United States, it will not be taxable if these three items are met. Number one, that Indian resident is not in the United States more than 183 days. Number two, the compensation is paid by the Indian parent, right? Not paid by a U.S. entity, not paid by a U.S. subsidiary. And then number three, the activities that are you know, employed here in the United States is not borne by permanent establishment. And permanent establishment is a term of art that's used in the treaty. And it says, you know, an Indian company will not be subject to United States income tax so long as it does not create this permanent establishment. And permanent establishment is defined in the treaty is that fixed place of business. And that fixed place of business means an office, a warehouse, a mine, a factory, right? Any fixed place of business that would there. So the question is well, if an Indian individual that's an employee of an Indian parent comes, that their compensation will not be subject to U.S. tax so long as they meet the first two bullet points here, and they are not creating permanent establishment, right? There's not an office, there's not a warehouse, right? They're coming here, they work from a hotel. That's not going to create a fixed place of business. But one of the footfalls that we need to be aware of in the treaty is that the language says if that employee habitually exercises the authority to execute contracts. So that's one that gets many of our clients, right? For example, let's say an employee of an Indian company is sent here to the United States. And the employee is staying in a hotel, so they're not creating a fixed place of business, right? They don't rent an office, they don't rent a warehouse, things like that, right? And they don't stay here in the United States in the aggregate exceeding 183 days, but they sign a contract here in the United States. That could be viewed as habitually exercising the authority to execute contracts, and that would potentially create a permanent establishment here in the United States. And in which case, if that were the case, then potentially both the Indian parent may be viewed as having a U.S. branch or subsidiary, and the compensation that is paid to that Indian employee may be subject to U.S. income tax. So we don't want a footfall. So, my suggestion always is that any contracts be sent back to the headquarters in India, in this example, so that they can be approved and executed in India. Right. And many times we get questions, well, Joe, what if the contract is signed electronically? What if it's done over DocuSign or something like that, right? And I don't know the exact answer, right? Other than I tell clients, well, send it back to Indian headquarters to get it approved, and if executed outside of the United States, we don't foot fault on that technicality and trigger permanent establishment, right? And so here, let to further that example a little bit, right? We've got an employee of an Indian parent who is sent to the United States to explore the market, right? Doing market exploration, doing research on whether their business will have a sustainable model here in the United States. And that individual does it, all through hotels, does not rent any office space or anything like that. And that employee investigates a vendor to work with, and that vendor wants to sign a contract, and that employee says, okay, great, we will sign a contract, and they do it here in the United States, right? That would be one of the gotcha areas where that would potentially both create a permanent establishment for the Indian parent and potentially make that compensation taxable, because we have violated this last bullet point of permanent establishment here in the United States. So, Jugal, any thoughts or questions on that?
See, I just had one doubt, Joe, on this. As you said, I'm not. Maybe I have a question relevant for other independent services, but here in this fact as well, if the agreement are being the contract of employment or the agreement for employment is being signed, or say the offer letter has been signed outside US, is that the only criteria for not creating P? I mean, if we are ensuring that the P is not created, does that tantamount to that? I mean, can that be directly proportional, or other checks as well we need to do while talking about dependent personal services?
Yeah, yeah, really good question, right? Is so the India U.S. treaty will say that permanent establishment is triggered under two circumstances. First was, is there a fixed place of business being created, right? And we've talked about what that is. And then the second criteria is, does the Indian individual habitually exercise the authority to conclude a contract? And unfortunately, that habitually has been interpreted to mean just once, right? That, unfortunately, U.S. courts have said that, hey, if that contract is executed in the United States, right? And Jugal, in your example, you said, let's say that Indian executive comes to the United States and wants to hire an employee, right? And makes an offer of employment to a U.S. individual, and that contract is executed in the United States, right? That would be habitually exercising the power to conclude a contract in the United States. So alternatively, we say, always send that contract back to India and have it executed outside of the United States so that we do not trigger permanent establishment.
Okay, okay, got it.
Great, great. Okay, now let's see. Let's go on. I know that DVS and its affiliates have got operations in Singapore. So Sierra and I just wanted to point on the fact that there is currently no income tax treaty between Singapore and the United States, right? So we don't have the protections of an income tax treaty. So what I just mentioned about the aggregate of 183 days, and that compensation paid by a foreign company and not creating permanent establishment. Well, now without the benefit of a treaty, those thresholds are much less, and in fact, we don't have the guidance of a treaty, and so we have to look at things on a facts and circumstances type of basis. And same thing with the UAE, right? We know that DVS also has operations in Dubai. Currently, we've got no income tax treaty between the United States and the United Arab Emirates. So now that makes things more challenging when there's a country that doesn't have an income tax treaty, because we're not given the guidelines and the protections of that treaty. It's very clear, right, for an Indian parent that sends an employee here, hey, as long as we meet all of the items in the treaty, we're okay. We're okay.
Joe, any specific reason for not having treaty with Singapore?
Say that again, Jugal.
Any specific reason why US has not entered tax treaty with Singapore? And secondly, apart from tax treaty, whether there are any other exchange of information agreement or other specified agreements between both the countries, or there are no such agreements at all?
Yeah, good question, Jugal. And I don't know the answer to that. Why? Singapore, there's lots of trade between the United States and Singapore. I think that we definitely, like India, view them as a strong ally and a friend of the United States. India, same thing, right? We have very, very, friendly and happy relations with India, as evidenced by the fact that we've got an income tax treaty. I don't know why one has not been agreed upon or executed. We have many clients that do business in Singapore, many United States multinationals, and for them, Singapore could be the gateway for Southeast Asia for clients that are doing business both in Singapore and Malaysia and Indonesia. And from what we understand, there are many benefits for doing business in Singapore, like having a reduced income tax rate if certain requirements are met, like research and development and things like that. And so, yeah, I don't know the answer to that one. I believe, Jugal, that the United States has certain trade treaties with Singapore. I don't know that for sure, but that's my gut feeling. But yeah, I don't know why that has not been executed. And same thing with the United Arab Emirates, right? Again, I have many clients that have operations in Dubai, and frequently travel back and forth. So yeah, I wish I knew the answer to that one.
Maybe in near future.
Yes, exactly. Maybe in the near future that will come to pass. And if you're interested, the Internal Revenue Service, that's the taxing authority here in the United States. They have a website, and they list all of the countries that the United States has an income tax treaty with. So if you get the chance and you're just curious, just Google U.S. income tax treaties, and IRS, and that will be the first item that will come up when you search for that in your browser, and you can see that and to your point, Jugal, the United States has an income tax treaty with China, but it doesn't have one with Hong Kong. And that's interesting to me. The United States has had a long trading relationship with Hong Kong, and so I don't know why that is in place there. So good question though.
No worries.
Okay, let's see. Okay, now let's talk about independent personal services. Right here, the distinction is that let's say an Indian national comes to the United States. Let's say as an independent contractor, to start their own business. They're not an employee of an existing business in India, and they come, as Sierra mentioned, as an E2 investor visa, right? Or maybe one of the E-series visas. What under the treaty triggers taxable presence here in the United States? And so, any income that would be derived by an Indian resident in respect to independent contract services, right? They are performing services on their own behalf. They're not an agent for someone else. These two bullet points are the rule here in the treaty. So again, it's not attributable to a fixed base regularly available to him, right? So think about, kind of the language of permanent establishment, no fixed place of business in the United States, right? And that's a little bit different from an E2 visa holder, right? Because an E2 visa holder is generally coming here and they are establishing a fixed place of business, right? But if an independent contractor just came here periodically, they've got some specialized knowledge and they've got some clients here in the United States, let's say for computer programming services, something like that, and they worked out of a hotel, and they worked on their client site, for example, right? That's not going to create a fixed place of business. And then if the stay is less than 90 days in the aggregate during the year, then that independent contractor is not going to create a taxable presence here in the United States. So right, that and I think the example here is, let's say, an Indian national who has their own business, and they service clients all around the world, including clients in the United States, and they fly here to the United States, and they're here less than 90 days, and they stay in a hotel or they work on site at their U.S. customer's office, for example, right? That will not create, that compensation will not be subject to U.S. income tax there. So, similar concept to the dependent personal services. Here we're talking about independent personal services, i.e. independent contractors, right? And then the same point with Singapore. We don't have a treaty between the U.S. and Singapore, so we look to the facts and circumstances of every case. We don't have that protection, and same thing with the United Arab Emirates there. Okay. Let's keep going. Okay, hey, the next one is this base erosion and anti-abuse tax. And this was put into place back in 2018 with the Trump-era Tax Cuts and Jobs Act. And this rule is best explained in an example, right? Let's say that we've got a foreign entity, and let's say it's just an Indian parent corporation. It owns 100% of the stock of a U.S. subsidiary, and that U.S. subsidiary is conducting business here in the United States at the direction of its Indian parent. And the U.S. subsidiary generates $300 million in sales. Well, and on top of that, the Indian parent says, all right, U.S. subsidiary, we're going to charge you a royalty for the use of the Indian parent's intellectual property. And that could be trademarks or trade names or patents or know-how or manufacturing know-how or marketing brands or things like that, whatever. Right, the U.S. subsidiary is using the name and the intellectual property that was developed by the Indian parent. And as a result, the U.S. subsidiary needs to pay the Indian parent a royalty for the use of that intellectual property. And let's say in my example that the royalty amount is $280 million. And so in that situation, that royalty expense would reduce the U.S. subsidiary's taxable income by that 280 million, leaving it with 20 million of taxable income. Well, here in the United States, that $20 million of taxable income will be subject to a 21% federal corporate income tax, and it would cut a check to the IRS for $4.2 million. But as you can see, that royalty that was paid up to the Indian parent significantly reduced the U.S. tax base. And so in that case, this base erosion and anti-abuse tax rule comes in and says, well, if you eliminate that royalty and instead add it back and multiply taxable income by 300 million and multiply it by a minimum tax rate of 10%, you would get a U.S. tax of 30 million. So instead of paying $4.2 million in U.S. tax, this BEAT tax says, well, we are going to disregard the royalty payment, and we're going to tax you at this minimum tax of 10%. So $300 million times 10% would give us 30 million. So the BEAT tax would essentially be, call it this $25.8 million of BEAT tax plus the $4.2 million of regular income tax to get us to a total tax of $30 million. And so this base erosion and anti-abuse tax effectively says we're going to impose this minimum tax, especially when there are intercompany transactions such as royalties or management fees or things like that. So that's just something to be aware of. All right, let's see. Let me move on now. Okay.
Joe, we received one query here in our WhatsApp group. Here, you just mentioned the example about how beat tax would be levied by the U.S. authorities. So, but there would be parameters to confirm, correct? Like whether the payment of 280 million was genuine or not genuine, or whether it was a business expediency, or what for that matter, if the 280 million is justified to be at arm's length under the transfer pricing regulation. If
Yeah.
those are the factors, whether still this beat would be applicable.
Yeah, no, that's a great question, right? And let me just summarize it, Jugal, and that is, hey, well, the beat tax comes into a play by disregarding that $280 million royalty payment that was made to the Indian parent. Jugal's question is, well, boy, that royalty payment seems awfully high. How does that correlate with the transfer pricing rules in the United States? And the answer to that, Jugal, is yeah, absolutely right. We would need to make sure that $280 million royalty is truly arm's length. And so we would go through all of the methodologies that we talked about last time to making sure that meets both the arm's length rules, as promulgated in the United States, and the rules that are promulgated by the OECD, the Organization for Economic Cooperation and Development, that makes many of the worldwide transfer pricing rules. Right, and generally here in the United States, Jugal, to your point, we generally do a cut search. We would do a search for similar royalty agreements, and we would do that search and put together an arm's length range of similar agreements with similar terms in similar geographic regions, and have as much similarity as possible, right? In this case, the royalty percentage is egregious, right? 280 million divided by 300 million gives us a 93% royalty rate on their sales. And right, in practicality, I've never seen a royalty rate that high in that situation, right? And I just use that 280 million as a as kind of an over exaggerated example of how this
onus would be on the taxpayer or on the department to prove, say, whether it would be on the taxpayer to justify that 280 is, 280 doesn't seems to be, it seems to be like humongous. But my question is like, what if he can substantiate to an extent of say 50 million or 100 million for that matter? So whether the only 180, say 100 million for that matter, and only 180 would be subject to beat tax, or the onus is on again the department to confirm this. Who has the responsibility to justify this?
Yeah, good question. So in the United States, let's say the U.S. subsidiary filed its tax return and it reported, this 20 million of taxable income, and the U.S. tax return would say that it would report this $280 million of royalty expense to its Indian parent. And in the United States, the U.S. subsidiary is required to have its own transfer pricing documentation that we call it contemporary documentation, meaning there needs to be the U.S. subsidiary performs its own analysis using the US rules and the OECD rules, and it documents how it has determined that the $280 million would be an arm's length transaction, right? You and I know that 280 million would not be arm's length, because we've seen a royalty agreement with a 93% of sales, right? I generally see royalty agreements between 2% to 10% on the high side, right? But that contemporaneous documentation, if the IRS audited the U.S. subsidiary, which would be very highly likely, because it would get a tax return, and that tax return would have that $280 million reported to a foreign parent. And so there's a very high likelihood that would be audited, and the IRS would most likely disallow that royalty expense, and say that is absolutely outside of arm's length principles. And, you need to pay us, and they would make an adjustment and say, well, we think a more likely royalty would be a 5% royalty or a 3% royalty. And so, if it were a 5% royalty, then we would have a $15 million royalty payment instead of $280 million, and taxable income in the United States would be $285 million, and $285 million of taxable income at the 21% corporate rate would result in almost $60 million of tax, as opposed to the $4.2 million of tax on the 20 million.
Got it.
Yeah. Great. Okay, hey, the last section we wanted to talk about was to go into a little bit deeper dive into U.S. sales tax, right? We frequently get this question from many of our, our Indian-based clients that don't have a physical presence here, but they are remotely selling their products here in the United States, right? They don't have a fixed place of business, but they are online, they are e-commerce sellers. They are online sellers. They've got great products that U.S. customers are buying, and they say, "Hey, Joe, tell us how the U.S. sales tax work." And so, just a refresher, we hit upon in webinar 1, but wanted to go into a little bit of a deeper dive. Right now there are 45 states that currently impose a sales and use tax. And the average U.S. sales tax rate today is 8.5%. And the sales tax here in the United States is imposed on the end customer, which is unlike VAT or GST, where VAT or GST, from my understanding, is imposed on every transaction in the supply chain. So to give you an example, right, U.S. manufactures a product, and that U.S. manufacturer sells that product to a wholesaler or a distributor located in the United States. On that transaction, the manufacturer does not charge U.S. sales tax generally to the distributor or the wholesaler. And then let's say that distributor or wholesaler, who's a U.S. business, resells it to a retail customer, and that retail customer, that supplier or that distributor or wholesaler does not charge U.S. sales tax to the retailer, because the retailer is not the end customer. But now the retailer sells that to the end customer. Let's say that's an individual, right? That's me. I go into a department store and I purchase a pair of shoes, and the retailer says, "Joe, the purchase price of those shoes is $100, but there is $7 of U.S. sales tax that they charge me." And I give them my credit card, and the retailer swipes my credit card for $107, $100 of which is the purchase price, $7 of which is the sales tax. And then the retailer then takes that $7 and remits it to the state of Utah and says, State of Utah, I had a sale to an end customer for $100. I collected $7 from Joe and remit that to the state of Utah. And the state of Utah uses that for for education or for roads or whatever the case may be there. So again, sales tax is imposed on that end transaction. It's a transactional based tax. It's not a tax that's really based on the good or service. So hopefully that example help solidify that. So, again, there's no federal sales tax. It's a state by state concept. And we don't have a federal value added tax here in the United States. So the US federal government does not have any of this transactional based tax. I take that back. For certain products, there are. For alcohol, for gasoline, right? Certain very specific industries there are, but generally there's no federal sales tax. This is a state by state concept, right? And as I mentioned, there are 45 states that impose it, but some states allow their localities to impose a sales tax. For example, Alabama and Colorado, they say they have a county or a city or a school district type of tax, and it makes sales tax administration very painful, especially in those two states where they say, well, you just don't file a Colorado sales tax return or a Alabama sales tax return. You file a county by county sales tax return. And so this second bullet point is that there are, over 13,000 state and local jurisdictions for sales tax. And this last point is that states impose a sales tax collection and remission liability on the seller once certain thresholds are met, generally number of transactions or dollar amount sales. And we're going to get into it a little bit there. And I'm cognizant of time, right? We've got about 9 minutes left in the webinar. I think I'm going to end with 5 minutes left to answer any questions that anyone may have. But I'll just keep going for then. Is that okay with you, Jugal?
Yes, that's totally fine, Joe.
Yep. So now we ask ourselves, if I'm an Indian manufacturer and I am selling product here into the United States, at what point am I required to collect and remit sales tax? And the answer to that is, well, are you selling to end customers, yes or no? If the answer is no, we're not selling to end customers, we're selling to a wholesaler or a retailer, generally there is no sales tax. But if that Indian manufacturer is selling to end customers through electronic commerce, the question we have is, at what point does that Indian parent have nexus, right? Nexus means, is there enough of a presence in the state so that the state can impose that sales tax? And prior to June of 2018, the rule was that the online seller had to have a physical presence in the state. And so, prior to June of 2018, let's say that e-commerce seller sold their manufacturing product to me, right? I went online, I bought a product from that Indian manufacturer and they shipped it to me, but they have no physical presence in the state of Utah. In that case, there would be no sales tax responsibility at all because they had no physical presence. But then fast forward to June of 2018 when the U.S. Supreme Court ruled in the famous Wayfair case that if an out-of-state seller had $100,000 of sales annually or 200 transactions annually, that's enough of an economic presence to cause that out-of-state seller to have the responsibility to collect and remit sales tax. So let's go back to that example. Indian manufacturer has sold, more than $100,000 of product into the state of Utah in the year 2020. So now they have reached the economic thresholds. They have no physical presence in the United States, but their economic presence is high enough. It's exceeded the $100,000 of sales or turnover annually. And so now the Indian parent should register with the state of Utah, obtain a sales tax license, and collect and remit sales tax. So once they met that threshold, the Indian retailer would say, okay, there is an online order. Joe Hillstead has purchased a pair of shoes, and that purchase price was $100, and the sales tax rate in Utah is $7. So the Indian retailer needs to collect $7 from myself, and so the total purchase price will be $107. And the Indian manufacturing company should remit that $7 to the state of Utah and file a Utah sales tax return indicating that they had a $100 sales. And so this new rule basically indicates that companies that no longer have physical presence, companies no longer have to have a physical presence in the United States to create a sales taxable presence there.
And Joe, I think it's important to note too that not every state, the threshold isn't 100,000 in every single state. So like California and Texas, for example, their dollar amount sales thresholds are 500,000 instead of 100,000. So you want to make sure, because every single state has different threshold requirements.
Yeah, great point, Sierra. Yeah, absolutely right. Each, just to echo that point that Sierra made, each state has established its own thresholds. California is at 500,000. Texas, right, I think is also at 500,000. The state of New York. Larger states have bigger thresholds. Smaller states like Utah, our population is 3 million people. We are not a populous state. We're a large state in terms of geographic area, but not many people, right? Our threshold is that 100,000 or 200 transactions. So, so for online sellers and e-commerce sellers, this creates a compliance burden for them, and it impacts both U.S. companies and foreign companies. You can be a Singapore seller, you could be an Indian seller, you could be a UAE seller. Doesn't matter. Still affected. So, let's see. In the interest of time, let's keep going here. All right, I think we've covered that. Yep. Well, Sierra, why don't I pause there? Why don't I get your last parting thoughts before we open it up to questions?
Okay, so just on the future of the U.S. tax policy, we're obviously being impacted by large and growing federal deficits. And there may be tightened international tax rules beginning in 2026 as we move forward.
Yeah, and to Sierra's point, right, the coronavirus has impacted the U.S. economy significantly. There has been stimulus payments, and the U.S. federal government is running deficits. We think that that's going to cause taxes to increase in the future because of those federal deficits, and further having President Joe Biden in the White House, his proposals are to increase taxes on the rich and also on corporate taxpayers, and so we think that there's going to be increased taxes in the future. So with that, Jugal, I'll pause there for questions. It's been a pleasure to talk about doing business here in the United States. I hope that this webinar has been helpful. As Sierra and I have really appreciated the opportunity to discuss this with your clients, Jugal, and so I'll turn it back to you.
Pleasure, Joe, and I would certainly mention that point that in the last 3 sessions in a span of a month, given valuable insights about doing business in US, and also some very nuances were covered as to what it makes or what it takes for doing business in US, and few of very relevant information from the tax perspective, or from actually doing business perspective, from the permits perspective. So quite a good insights were provided in across all the three sessions. Yes, still even few more sessions would not be enough to cover many things, but we have touched upon almost something of everything. So in case if someone wants to deep dive, they can always mail it to me or to Joe as well. Maybe if they can mail it to me, and if they are keen enough to understand a bit more about that, we can certainly connect offline and take it forward. So the one question was whether this PPT, the presentation, would be shared. I said the three questions which were done, whether this PPT would be shared. Yes, the PPT would be shared, and also will be circulating to all our viewers who joined and who could not join. But yes, we will be sharing our PPT. One doubt which I had, Joe, relating to sales tax. Now, the seller is in one state, and the buyer is of another state. So, which state will have the rather authority to levy and collect sales tax? Where the seller is registered that state, or where the sale is in that state?
Yeah, really great clarifying questions, Yugal. The answer is generally the buyer state. The buyer state
Okay.
is the state. So let's say I am an online seller in Utah, and I sell a product to a customer in California, and we've met the nexus thresholds in California, meaning we have either a physical presence there or we've had enough sales there, then me as the seller is required to charge California sales tax. So if the buyer lives in Los Angeles, we look at usually the address of that buyer in Los Angeles and say, what is the sales tax rate at his address, and we charge sales tax based on that California sales tax rate in his address. Does that make sense?
Yes, yes, yes. That makes Joe. Good to clarify that.
Great.
So I think so. It's like 2 minutes beyond 8, and here in India, so we can conclude that there are no more questions, or if anyone has it, they give it to us, and we can pass it on to you, and then you can clarify. But thanks a lot, Joe. Thanks a lot, Sierra, for these sessions across the last 1 month, and it was great to have you. Certainly, we'll catch up on something else, something very interesting in future. Till then, thank you and goodbye, Joe.
Great. Thanks, Jugal. Our pleasure. Thanks, everyone. Really appreciate it.
Thank you, Joe. Thank you.